to the fixed asset note. The following information was extracted from the records of Majoro Traders for the financial year ended 31 December 2018. The business is owned by brothers Peter and Joe Majoro. Required to do the fixed asset note on 31 December 2018. Okay. Then you are told to indicate the workings in the section provided in your answer book. Okay. Information. Extract from the post-closing balance on date 1 December 2017. So remember, our year ends on date 1 December 2018, meaning that our year starts on 1 January 2018 to date 1 December 2018. Meaning that because this was a closing balance for 2017, it's going to be the opening balance for 2018. So it's going to be the balance at the beginning. So this is our balance at the beginning for the vehicle. It's 90,000. Then for the equipment, it's already provided. And then we are also given the accumulated depreciation for the equipment is 7,200. The next thing, the following assets were bought during the current year, 2018. So we're not given a vehicle, but what we are told that it was bought on 30 September 2018. Okay. Equipment bought for cash on 1 June 2018. So both of them were bought on 1 June 2018. And then they are 25,000 and then 2,000. So meaning that we have the additions for the equipment of 27,000. We have the additions for the equipment of 27,000. Okay. What else is given? A vehicle for 90,000 was acquired on 30 June 2016. So remember, we are not given the accumulated depreciation for the vehicle, meaning that we have to calculate it. So it was bought on 30 June 2016. So let's go into the calculations. So we have a vehicle. So the 90,000, the cost price. So on 2016, it was bought on 30 June, meaning that it stayed from 1 July to 31 December 2016. So it stayed for 6 months. So I'm going to say 90,000 times 20% times 6/12. So at this time, this vehicle was still new. So 90,000 times 20 divided by 100 times 6 divided by 12 is equal to 9,000. And then 2017. So for 2017, this vehicle stayed for the whole year. So 90,000 minus 9,000, we are subtracting because we are told that vehicles are depreciated at a 20% per annum on the carrying value. So this is the diminishing balance method. So for the diminishing balance method, you say cost minus accumulated. So because this depreciation on 2016, it was a depreciation, it means that on 2017, it's going to be the accumulated depreciation. So 90,000 minus 9,000, it's 81,000. times 20% is equal to, so this one stayed for the whole year, times 20 divided by 100 is equal to 16,200. And then 2018, okay, still like this. So this means that the accumulated depreciation at beginning on 2018 is going to be 9,000 plus 16,200 is equal to, let's check if we have space for that. So we don't have the space for that. So 9,000 plus 16,200 is equal to 25,200. Now, to calculate now the depreciation for the current year, which is 2016, we need to say cost minus the accumulated, which is 25,200, is equal to 90,000 minus 25,200 is equal to 64,800. Okay, remember we said that this is the accumulated depreciation at the beginning of the year of 2018. So let's go and record it. It's 25,200. So times 20% is equal to divided by 100 is equal to 12,960. So this is the depreciation of the current year. Now we are told to calculate the depreciation for the year. Now, how do we calculate the depreciation for the year? So to calculate the depreciation for the year, the first thing that you must know is that to get the accumulated depreciation at the end, we must say accumulated depreciation at the beginning plus the depreciation for the year is equal to accumulated depreciation at the end. Okay, but then if there was a disposal, so obviously you need to subtract that accumulated at the date of it was sold. You need to subtract it. Subtract the accumulated depreciation of the assets sold at the date of it being sold. So accumulated depreciation at the beginning of the year is 25,200 plus, so we are not given the depreciation. And then accumulated at the end, it's given. The balance of the accumulated depreciation on vehicles after taking the above into account was calculated at 40,060 on 31 December 2018. And it's given here. It's here, 40,060. So let's go. Equal to 40,060. So now we just have to do this mathematically. So just group the like terms is equal to 40,060 minus 25,200. So the depreciation is equal to 40,060 minus 25,200 is equal to 14,860. This is the depreciation. 14,860. Okay, and then calculate the depreciation for the new vehicle. Now, to calculate the depreciation for the new vehicle, what you're going to do is we have already calculated the depreciation for the old vehicle. And then now we have a depreciation for the year. So the depreciation for the year is including the depreciation of the vehicle that was bought and also the depreciation of the old vehicle. So we just have to find the difference, which is the depreciation of the old vehicle. So we're going to say 14,860 minus 12,960 is equal to 1,900. This is a depreciation for the new vehicle. And then the next one, because here we were told that a second vehicle was bought on 30 September 2018 and it did not give us a cost. So we need to calculate that cost. So to calculate the cost, we are going to say 1,900 times the percent is 20%. So meaning that this 1,900 it is for 20%. So below you put what you have, and then what you don't have is a cost, which is 100% times. So this vehicle was bought on 30 September 2018, meaning that it stayed for 3 months, October, November, December. So I said below you put what you have. So what you have is a depreciation of 3 months. And then what we're looking for is a cost. So 1,900 times 100 divided by 20 times 12 divided by 3 is equal to 38,000. So this is your cost, the addition of the new vehicle is 38,000. 38,000. So no vehicles were sold during the current period. Okay, let's just do the calculations. So 90,000 minus 25,200 is equal to 64,800. So we don't have a disposal because no asset was sold. So 38,000 minus 14,860 is equal to 23,140. Now, to get the cost at the end, you say cost at the beginning plus the additions minus the cost of the vehicle sold. So we don't have a vehicle sold. So 90,000 plus 38,000. 90,000 plus 38,000 is equal to 128,000. 128,000 minus 40,060 is equal to 87,940. Now let's move to the equipment. Okay, so what are they saying about the equipment? What are they saying about the equipment? On 31 May 2018, Jomo Joro bought outdated equipment. So here they were supposed to say, let me erase this. They were supposed to say So they were supposed to say sold. So they were supposed to say sold. So on date 1 May 2018, Joe Mojoro sold outdated equipment at a cost of 2,400 at a loss of 500 from the business. The book value of the old vehicle is 840. So that is the book value. Now, let's go and check the calculations. Let's go and check the answer sheet, because the answer sheet is the one that is guiding you. So, first thing first, we are told to calculate the depreciation for the new equipment. The depreciation for the new equipment. So, how much is the new equipment? The new equipment, it is 27,000. It's the addition. It's given. It's here. The addition of 27,000. This is the new equipment. So let's calculate the depreciation for the new equipment. It's 27,000 times. So what are they saying? What are they saying? So they are saying, what are they saying about the new equipment? So the new equipment, it was bought on 1 June. It's written here above. They were bought on 1 June, both of them, 2018. So meaning that, and also we are told that the depreciation is a 10% on cost. So times 10% times they were bought on 1 June 2018. So they stay from 1 June to 31 December. June, July, August, September, October, November, December. So they stayed for 7 months. So 27,000 times 10 divided by 100 times 7 over 12 is equal to 1,575. And then now, assets sold. Now we're calculating the depreciation for the asset sold. So the cost of this asset is 2,400 times 10% times it was sold on 31 May 2018. So this equipment stayed from January, February, March, April, May. Then on May it was sold. So it stayed for 5 months. So 2,400 times 10 divided by 100 times 5 divided by 12 is equal to 100. So it's 100. And then now for the old asset. Now we're calculating the depreciation of the old asset. So the asset at the beginning of the year is how much? It's 26,000. It's 26,000 the cost. So it's 26,000. So we are calculating the depreciation for the old asset. But remember, there was an asset that was sold for 2,400. So we need to subtract that asset, because that asset did not stay for the whole 12 months, and we've already calculated its depreciation. So 26,000 minus 2,400 is equal to 23,600. So this is the asset stage for the whole year. So times 10% is equal to, so the answer is 2,260. So we said 26,000 minus 2,400 times 10 divided by 100 is equal to 2,360. Now, this means that the depreciation for the year, so we need to add all the three to get the depreciation for the year. So it's 1,575 plus 100 plus 2,360 is equal to 4,035. 4,035. Okay. Carrying value of asset sold. Carrying value of the asset sold. So what did they say about the asset sold? What did they say about the asset sold? On data May, Joe Mojoro sold outdated equipment at a loss of 500 Rand from the business. The book value of the old asset was 840. Now you know that to get the carrying value, say cost minus accumulated depreciation, then you get the carrying value. So which is the same thing as the book value. So we are given the cost. The cost is 2,400 minus, here we are told to the carrying value. We are told to calculate the carrying value of the assets sold. So minus, so we are not given the accumulated. But then we are given the book value, it is 840. So then we just take this 2,400 to this side, 840 is equal to, then you take this one to this side. So the accumulated depreciation is equal to 2,400 minus 840 is equal to 1,560. So this is the accumulated depreciation at the beginning of the year. Now, because now because we have calculated so we say 2,400 minus 840, then we get 1,560. Now 2,400 to get the carrying value of the asset sold. So 2,400 minus 1,560 minus the depreciation, because the asset has to be sold and because you also need to subtract the depreciation of the current year. So we have subtracted the depreciation the accumulated at the beginning of the year, we must also subtract the depreciation of the current year, so that we are going to know this. At the date of which this asset was sold, how much was its carrying value? So you say 2,400 minus 1,560 minus 100 is equal to 740. So this is the carrying value of the equipment sold. So it's 740. Okay. And then the next thing, accumulated depreciation at the end of the year. So to calculate the accumulated depreciation at the end of the year, we must say the accumulated depreciation at the beginning of the year, so which is 7,400 plus the depreciation during the year, which is 4,035 plus 4,035 minus, because there was an asset that was sold, so we need to subtract its accumulated depreciation. That is including the depreciation of the current year. So we need to subtract 1,560 minus 100 rand is equal to, so 7,200 plus 4,035 minus 1,560 minus 100 is equal to 9,575. So the accumulated depreciation is 9,575. So let's just do the calculations. So it's 26,000 minus 7,200 is equal to 18,800. And then the movements, we have 27,000 minus 740 minus 4,035 is equal to 22,225. Now to get the carrying value, let's say 50,600 minus 9,575. 9,575 is equal to 41,025. Thank you.